Hey everybody, Economic Ninja here. I am so blessed to have with me Rick Rule. Mr. Rule, how are you doing?
Life is great. Thank you for having me on. I love conversations like this, and so thank you for letting me engage in one.
Awesome. I've been following you recently, the last couple of years on LinkedIn, and I don't want to sound corny, but your depth of understanding of metals and markets is so deep. I try and show my subscribers how important it is when you get a lot of information at once. It's important to really take time to reflect and learn on what you just learned. And your words have never disappointed me, quite frankly. So I'm super excited. So thank you again for being here.
Thank you. I appreciate it.
All right, so let's start. We're going to make this real simple. These are pretty much, we're going to talk about two topics. I want to talk about if we can find historical precedents of what we're going through now, like these are unprecedented times. And then I want to talk about the Wall Street silver movement and silver as an investment. So but first, we'll start with history. So we are in interesting times. What do you think about being able to show people historical perspective and what it was like? Is there anything that you can think of in recent history or ever that we've ever seen like this?
I forget who it was that said it, but somebody said that if history doesn't repeat, at least it rhymes. So the circumstance that confronts us today is probably unique, but personal behavior and institutional behavior doesn't change, or at least it rhymes. So when you talk about a bull market, you need to talk about a bull market what? Because different asset classes exhibit different behaviors during bull markets. Natural resource bull markets always begin in natural resource bear markets, because despite the political class, despite their wishes to the contrary, markets, however messy they are, work. So always the cure for high prices ultimately is high prices, and the cure for low prices is low prices. Precious metals bull markets are particularly interesting because in addition to industrial and commercial applications, precious metals are money. And it isn't purely an economic cycle or an industry cycle that drives them, but rather political and social cycles. So while the precious metals bull market that we're in today expresses some similarity to the precious metals bull market, as an example, in the 1970's, which is to say negative real interest rates, the depreciation of the currency outpacing the yields that are offered in conventional savings instruments, and also resembles the 1970's in the sense that there is an unhealthy reliance on government among the population. There are differences between now and the 1970's too. The good news is that there's much more trade in the world, and very poor countries in the world are much richer than they used to be, which is a very good thing. We have a much more inclusive economy. I'm not saying inclusive from a politically correct standpoint, but more people have the ability to contribute to society than ever did, which is really good. And technology is much better than it was in the 1970's. As an example, you don't have to have as much knowledge anymore. You have to have access to Google, who, while they may censor stuff, still has stuff available, at the sort of a keystroke. So all that stuff is good. What's bad, and it's really bad, is that politically or as a society, we have much more debt relative to GDP than we had then. And I would argue that the debt is, from a political point of view, unserviceable.
Yes.
Throughout history, if you had a circumstance like this, you had a very messy outcome, and then the market would correct it. That messy outcome might involve a war, might involve starvation, a bunch of bad stuff. The circumstance we have now, just looking at the United States federal debt and deficit, will give you an illustration of that. $28 trillion in on-balance sheet liabilities. The trillion, by the way, is a very big number. It's 12 zeros, to the left of the decimal point. But the off-balance sheet liabilities are even worse. And by the way, I'm one of those. I'm an old guy. Medicare, Medicaid, Social Security, all that kind of stuff.
Yeah.
The off-balance sheet liabilities at the federal level, before state and local, are, according to the Congressional Budget Office, well in excess of $120 trillion. So at the federal level, we have $150 trillion in liabilities. And we propose to service this debt with the national income. Unfortunately, the national income, which is to say taxes and fees less expenses, adds to the deficit, $4 trillion a year. It's very difficult. The old adage, when you've dug yourself a deep hole, first thing to do is stop digging. And I think that debt is unserviceable. It could be serviced. Mm-hmm. Young people could say to old people like me, you voted yourself all these cool benefits, you pay for them. We're going to default. We're going to renege. That'll get you some hate mail on your channel from people who believe they're due their Social Security, but that's one way out of it. The way we got out of it in the 1970s was to inflate away the net present value of the obligations. In other words, depreciate the currency. Because the aggregate debt levels were fixed, they didn't pay attention to the denominator, the value of the US dollar. You were able, over the course of the decade, to get rid of, in net present value terms, about 60% of the obligations that as a society we faced. And I suspect that's probably what happens this time, a fairly messy outcome. Sorry for that long-winded answer.
No, I love it, actually, because you bring up a great point, because not only are you talking about high government debt right now on the books, and essentially on books and off books with derivatives, but also we're seeing historically low interest rates. Now, unlike the 1970s, late 70s, when we saw a massive amount of inflation, Paul Volcker, in what I believe was 1980, hailed as a hero at that time, spiked interest rates to quell inflation. But we don't exactly have that opportunity or that option these days, do we?
Well, I think it's a pity. I think we should. I think we should let the market take over interest rates.
Oh, I agree.
That would obviously cause an awful lot of near-term pain.
Yes.
An awful lot of near-term pain, and a lot of maybe not innocent, but certainly naive people. People who don't understand the way the economy works would suffer grievous damage. One thing that illustrates this, I guess, is that over 3 decades, the mean real interest rate on the US 10-year Treasury was about 150 basis points positive, sometimes as much as 250 basis points. If that were true, the Congressional Budget Office just told us, not some cranky old bald libertarian, but the Congressional Budget Office told us that at the current CPI stated rate of inflation, the currency is depreciating at about 4.5% compounded a year. So if the interest rate on the US 10-year Treasury were to revert to mean, it would be 150 basis point premium to the inflation rate, meaning that the interest on the US 10-year Treasury would be at 6% rather than 1.5%.
Yeah.
If that were true, you can imagine what first mortgage rates would be like, what municipal rates would be like. And I suspect that you would have a Volcker-like outcome. Remember that when Volcker spiked the interest rate, that the CPI stated rate of inflation was in double digits.
Yes.
And my suspicion is that we might be able to forestall an inflation rate in double digits if we let a real market develop in interest rates. This is an esoteric discussion.
No, but I like it.
The voters wouldn't allow it.
Yeah. No, you're absolutely right. And actually, so let's now we start talking, and you're giving me all these great ideas. Let's talk about you were talking about letting the market decide where the interest rate goes. But we're seeing some interesting things where the banks are putting their money right now with the repo facility that I believe, I don't know if it's crossed $1 trillion yet, but it seems like it's getting close after the Fed offered about what I believe 0.5% interest rate to keep their money on loan. So now we're seeing ballooning amounts of money in this facility, where I believe, if I'm not mistaken, that that's less money that's being lent out into the public as well. So in the form of mortgages, car loans, things like that. What is your take on that, especially now that we're seeing mortgage rates in the last 6 to 8 weeks tick up from 2.8% to 3.5%?
I should disclaim that I'm not an economist. I'm actually a credit analyst. So what I'm going to tell you now is supposition, nothing else.
Okay, perfect.
I think the larger repo facilities are a way of building ammunition at the Fed to cause to allow interest rates to rise a little bit while the economy is nominally strong.
Okay.
This gives the Fed the ability to lower interest rates. You can't lower them from nothing. If they need it, it gives them an arrow in their quiver. I think, although I don't approve of the Fed, what I approve of and don't approve of doesn't matter whatsoever. With that caveat, I think the fact that they're giving themselves some ammunition is very important. The fact that they've used what is nominally a strong liquidity-driven economy to cease yield management, that is to cease manipulating the long and midterm rates down and allowing it to rise, will give them the ability later when, as I suspect they will, they need to lower interest rates to continue the artificial stimulus that we've all enjoyed so much.
Yes. Yeah, I completely agree, actually. And I love your take on this because, like you said, is you're not an economist, but the amount of time that and you call yourself an old man, but it's so important to be able to talk to people that have been around this long and have seen in firsthand perspective these markets and how they can go up and go down. I love that you use the word arrow and a quiver because, like we saw with the dot plot plan years ago, it's an arrow each time they lower or raise interest rates. And right now, it seems like they don't have a lot of arrows left. It is an interesting dynamic, would you say?
Well, they've been able to allow the 10-year rate to go up from 60 basis points to 175 before backing it off to 150. If the current recovery, which I believe is mostly liquidity driven, but if the current confidence, say post-COVID, allows nominal economic activity to remain strong, I suspect that they could allow the US 10-year to rise over 2%. That makes people feel good, but it doesn't detract from the fact that you're getting paid 2% in a currency that's depreciating by 4.5%. Yes. My good friend Jim Grant calls this return-free risk. The idea that you would accept, that a sane person would accept a negative real interest rate is insane. What that means is that you save and you pay somebody else to take your money and consume it today while you take the credit risk and spend it later. It's not a form of, it's not a force of nature. It's collective. It's a government construct.
Yeah. Now that brings up another great thought of, like you said, self-proclaimed old guy, right? There's a lot of people though that would care less about 4% yield that they can get on deposit, whereas opposed to what that would do to the cost of buying a home. We're seeing a housing bubble that is quite frankly making 2006 look like a joke. And what would that kind of impact have on housing? And if so, if that started to make a negative impact, how big could that negative impact be in your opinion?
I don't know the answer to the second part of your question. Okay. With regards to the first part of the question, if we had reversion to mean in terms of positive real yields in the US 10-year, if you allowed the 10-year to go from 150 basis points to 600 basis points, and if the 30-year fixed rate was 100 or 150 basis points in excess of that, that would take the 30-year fixed rate to 7.5%. I don't think that you would have a affordability problem anymore, at least with regards to the gross sticker price. It would be difficult for people to afford their monthlies, but I suspect that the price of houses would come way off.
Yes.
Way, way, way off. Yeah. Whether or not that's a good thing depends on whether or not, whether you want to have the means to buy a house, whether you have the means to buy a house, pardon me, and want one, or that you don't. Yeah. I think it's important for people, when they understand the politics of these things, to understand that one facet of a democracy, I'm not defending or attacking democracy, but one thing that you have to understand is that part of the political process involves a war on savers by spenders.
Yes.
And spenders are more numerous than savers.
Yes.
So there is a strong argument on behalf of the economic majority to plunder the wealth of those who were more prudent and saved. And that will be with us forever. To the extent that you are a saver, you have to guard yourself against the depredation of the majority all the time.
Yeah, that's a great point.
Hey everybody, I wanted to cut the video short right there because there's so much information that we covered. I'm going to break this up into 2 videos. So I want you to take some time and think about economic cycles and everything that Rick had to say. It's absolutely amazing to me. I'm so excited to be able to have people like Rick Rule, David Morgan, Tom Wheelwright on this show. I'm so excited. The channel's been growing, but I wanted to give you some time to think about it, and then we're going to go into the next segment where Rick Rule talks about precious metals and Wall Street silver, which is really interesting to me because he talks about something he was totally wrong about. And coming from someone that is so amazingly successful like Rick Rule, it's really neat to be able to learn from people's mistakes or what they thought was wrong, right, and then it was wrong. I just absolutely love that stuff, and it's really neat that he shares it with us. So that being said, thank you guys for this episode. The Economic Ninja is out.